Generative AI has opened a new front in the power struggle between the unipolar and the multipolar world orders. Why is AI overturning the theory of economic convergence? What does it mean for US economic hegemony and the US dollar's reserve currency status? What does AI mean for the neutral rate of interest and the outlook for the Federal Reserve? More than 4 months into 2024, the US stock market is once again outperforming the stock market of the rest of the world. As of May 9th, MSCI USA has generated a total return of 9% year to date, whereas MSCI World ex-USA has generated a total return of only a little more than half of that. The US dollar has not done too shabbily either so far this year. The Fed's broad trade-weighted US dollar index is up 2.4% year to date. If we factor in carry, the dollar did even better. Among the 20 most liquid currencies in the world, the only currency that's done better than the dollar, and just barely so, is the Mexican peso. Are the outperformance of US equities and the outperformance of the US dollar this year somehow connected? If so, how? The foreign exchange market is considered the most difficult market in the world for a reason. Over the past 20 years, the broad trade-weighted US dollar index rose half of the time and declined half of the time. In other words, it was pretty much of a crapshoot. This is why very few people have consistently made money trading currencies. Trading currencies profitably may be difficult, but it is not impossible. There are some clues if you look hard enough. One of the most important clues is the high correlation between the relative performance of US equities and the performance of the US dollar. The broad trade-weighted dollar went up in 10 years out of the past 20 years. But in 8 out of these 10 years, the US stock market outperformed the stock market of the rest of the world. This suggests that to get the direction of the dollar right, it is very important to get the relative performance of the US stock market right. The high correlation between the dollar and the relative performance of US equities may seem obvious, but let me assure you that it is not. For example, it may be tempting to think that when foreigners buy more US stocks than Americans buy foreign stocks, it would benefit both US stocks and the US dollar. But the data do not support this flow hypothesis. Believe it or not, the data says that cross-border equity flows favor the US in only 2 out of the 10 years in which the dollar went up over the past 2 decades. Put differently, foreigners were mostly net sellers of US equities in years when the dollar went up. How can this be, you might ask? The reason is portfolio rebalancing. When US stocks outperform, the weighting of US stocks in global equity portfolio goes up. An investment fund that has a benchmark with fixed country weightings will then have to sell US stocks to bring its US allocation back in line with its US weighting. This channel implies that outperformance of US equities, if anything, will lead to more selling of US equities and US dollars by many global portfolios. In case you're interested, there's a whole academic literature devoted to this mechanism. For the purpose of this video, we can safely conclude that the observed positive correlation between US equity performance and US dollar performance is not a flow story. But if it's not a flow story, what is it then? The stock market has 2 main drivers. One is growth expectation, and the other is the risk-free discount rate. Stocks can go up because of either improved earnings growth outlook or because of lower interest rates. Which of these 2 drivers can account for the positive correlation between the dollar and the relative performance of US equities that we see in the data? Clearly not the interest rate channel, given that lower interest rates are any currency's worst enemy. This leaves us with just the growth channel. Can relative growth expectation be the driver behind the positive correlation between the dollar and the relative performance of US equities? The answer is, of course, yes. I plotted here the broad trade-weighted US dollar against nominal GDP growth differential between the US and the world. I use nominal growth here only because the equity market cares mostly about nominal growth as opposed to real growth. It is very clear that when US growth accelerates relative to that of the rest of the world, the US dollar tends to do well. But what really stands out on this chart is something more fundamental. From 2002 to 2011, the world economy grew faster than the US economy. Since then, the US economy has grown faster than the world economy. This level shift in the growth differential between the US and the world is a major, if not the main reason, for the relative strength of the dollar since 2013 compared to the previous decade. It is also likely the reason for the fact that the US stock market has outperformed the stock market of the rest of the world in 8 out of the past 10 years. The US has experienced a relative resurgence of its economic growth over the past decade. In many ways, this development is highly counterintuitive, because the economic theory says the opposite should have been the case. The US is already one of the richest countries in the world, measured in per capita GDP. This is because it has a relatively high capital to labor ratio. All else being equal, this should mean lower return to capital, lower investment rate, and lower economic growth rate. Why has this conventional economic logic, which seems to apply well to other rich countries in Europe and Japan, not applied to the US over the past 10 years? Technology and innovation are the obvious answer. If we look at sector-level earnings growth for S&P 500 over the past 10 years, information technology led the rest of the field by a wide margin. And the consumer discretionary sector would not have done nearly as well without Amazon and Tesla, nor communication services without Meta and Alphabet. Over the past 10 years, the return on S&P 500 is 300% higher than that of Stoxx 600, its equivalent in Europe, despite the fact that most US companies did not do much better than their European counterparts. The outperformance of the US stock market and the US dollar over the past decade comes down to the simple fact that no other country outside the US has a Microsoft or an Apple or Google or Nvidia. TSMC is the only non-US company that comes close. You can say whatever you want about these companies, that they are too big for the good of the world, that their monopolistic power is stifling innovation. But one thing is clear: their dominance has strengthened US economic hegemony and the hegemony of the US dollar. Just think of this fact, that in Q1, the combined earnings of these 7 companies increased by 50% from a year ago. This compares to the expectation of low single-digit contraction of the earnings of all other S&P 500 companies. I have no doubt that the massive increase in earnings of these 7 companies is the reason why the US economy did not go into a recession last year. These 7 companies powered the US stock market rally. That was the main driver of the $12 trillion increase in US household net worth last year that's kept US consumers spending. Thanks to these companies, the most aggressive Fed interest rate hikes in 20 years have failed to tighten US financial conditions. These 7 companies are the reason why the Fed will be the last major central bank to cut interest rates. In the age of big tech monopolies, micro has become macro. If the fate of the US economic hegemony and the dollar hegemony hinges on the continued dominance of the Magnificent Seven, there is no doubt that the continued dominance of the Magnificent Seven is riding high on AI. AI is boosting Microsoft's and Google's cloud business. AI is helping Amazon reduce returns in packaging. Nvidia is investing in its autonomous driving platform that could eventually give US car companies an important edge against Chinese competition. AI has become so central to the comparative advantage of the US that the Biden administration has not only banned the sale of advanced AI chips to China, but it is now considering restricting the export of proprietary or closed-source AI models to China and Russia. With the valuation of the US stock market at a 20-year high, and the US dollar not far from his 20-year high, the question is whether AI is already priced in. After Mark Zuckerberg said that it might be many years before Meta recoups its investment in AI, Meta stock price dropped sharply before recovering this month. The forward PE ratio based on 2025 estimates of these companies, with the exception of Tesla, don't look unreasonable. The question is whether the 12% EPS growth estimates for 2025 for S&P 500, after the 10% growth of this year, is realistic. I want to say no, but I'm having difficulties identifying a short-term catalyst other than obvious geopolitical risk that could force the market to rethink. AI is the most important new technology in the world since the internet revolution. Unlike the social media revolution or the smartphone revolution, AI will provide a big boost to labor productivity and profit growth over time. Regardless the outcome of the November election, the US government will do everything to maintain or increase the US monopoly in AI. Because advanced AI chips are expensive and building large language models expensive, the Magnificent Seven, with their huge profits, are in a strong position to invest and collect the rent on AI. AI will accelerate the development of robotics in the pace of reshoring. It is difficult to see how it's not very bullish for the US economy and the US dollar, at least on a medium-term basis. Short-term, it's a tougher call. I'm worried about geopolitical risks and trade wars, but these are supportive for the dollar as we've seen over the past 3 years.